Let's talk about something that's quietly causing tax trouble for U.S. companies doing business in Canada. Merchant of record services. They promise simplicity. They promise to handle all your sales tax issues, the collections, the payments, the compliance. It's all done for you. Sounds great, right? Well, not so fast. While these services can reduce your operational workload, they also create real tax exposure, especially when you cross borders. So in today's video, I'm going to walk you through what a merchant of record actually does, the hidden traps most CFOs miss, and how you stay compliant if you're using one of these services or considering using one of these services if you're a U.S. company doing business in Canada. But before we get going, let me make it perfectly clear. I am not suggesting in this video that you do not make use of the services of a merchant of record. Quite to the contrary, I encourage it. Just know the limitations of the merchant of record model. That's all I ask. Hey there, I'm Duncan McPherson and welcome back to my channel. I'm a dual qualified CPA in both the United States and Canada, and I specialize in helping companies like yours navigate that messy middle of cross-border taxation. And today's topic is something I've seen confused even the most experienced people. Because on the surface, merchant of record services look clean. They take your payments, they handle your sales tax, they issue you reports. But once you look under the hood, the story changes a little. Let's break it down. So what is a merchant of record? A merchant of record is a third-party service that processes your customer transactions on your behalf. They collect your money, they handle and remit your sales taxes to the CRA, and send you the payout, minus their fees, of course. They are often marketed as one-click compliance, the end of sales tax headaches, cross-border made simple. And to be fair, they can offer you real value, especially for high-volume digital sellers or startups entering new markets. But here's the problem. Most of them are built for simplicity, not tax strategy. And when you're operating in both Canada and the United States, that simplicity can cost you a lot more than you think. Here's where merchant of record services get very risky across borders. They often trigger cross-border tax consequences that go completely ignored. Here's just a few real-world examples I've seen with some of my clients. Yes, your merchant of record is handling your Canadian sales taxes, but you are still on the hook for the income taxes. You assume as a third party is doing the sales tax collection that you have no presence in Canada, but your Canadian revenues create a taxable presence. Now, these revenues may be exempt under the treaty, but at the first blush, you may have a taxable presence in Canada through the use of a merchant of record. The merchant of record is your seller in Canada, but you're still the entity earning the income, which means CRA, the Canada Revenue Agency, has the right to look at your books. And here's the kicker. None of your merchant of record services negate your corporate tax filing obligations, nor do the services of your merchant of record negate your treaty obligations. The merchant of record only handles sales tax. So while you think your tax burden is being taken care of, you may actually be sitting on unfiled Canadian tax returns with penalties mounting in the background. So if you're using a merchant of record or you're planning to, here's what I recommend. There are 3 questions you need to answer. Number 1, who is the seller of record for legal and tax purposes? If it's the merchant of record, that may simplify the sales tax, but it might complicate your financial reporting, your revenue recognition, and control over your customer relationships. Number 2, where is the income earned and by whom? If you're earning the income here in Canada, you may have a corporate tax filing obligation, even if you never touch the Canadian soil. The justification for this is similar to that of the Wayfair case in the United States. Number 3, what systems are in place to reconcile your revenue, sales tax collection, and cross-border compliance? Because we thought they handled that is not a defense when the CRA or the IRS comes calling. Everyone's expected to know the law. And if you're not sure of the answers, you need a cross-border tax plan that layers on top of your merchant of record, not a cross-border tax plan that blindly trusts it. Look, I get it. Everybody wants simplicity, but you can't outsource responsibility. The CRA doesn't care if your merchant of record said they'd handle all your taxes. If you're the economic beneficiary of sales into Canada, the burden is still on you to file. And this is exactly how U.S. businesses end up with surprise audit letters, missed T2 obligations, treaty violations, and double tax, even when you thought it was covered. So here's the move. If your company is selling into Canada, whether directly or through a merchant of record, you need to understand what that means for corporate tax, not just sales tax. Go to the MacTax.com and schedule a no-cost cross-border tax strategy call with me. We'll look at how your sales flow is structured, where the tax burden really lands, and how to stay clean on both sides of the border. Bottom line, merchant of record services are not the enemy. In fact, I encourage using them, as they provide quality backup of your earnings activities in Canada. They are not your tax strategy, they are a service provider. You can't assume they're handling what they never agreed to handle. So stay smart and stay documented, and make sure your cross-border tax plan covers the whole picture, not just the part that makes checkout easy. I'm Duncan McPherson. Stay sharp, stay compliant, and I'll see you on the next video. Thanks for watching.